Welcome to Yahoo Finance Live. I'm Shauna Smith along with Brad Smith, the power of the Smiths for the next 2 hours here on Yahoo Finance. Happy Friday, everyone. Let's get you up to speed on everything you need to know as the clock hits 3 p.m. Eastern time. Too hot to handle. Stocks falling as the Fed's preferred inflation gauge comes in above expectations, and hawkish comments from Loretta Mester adding fuel to that fire. But what exactly does this all mean, and why does it matter so much? Brad Smith is going to have all the answers for you here in just a minute.
Plus, 1 year on from the war in Ukraine, we're going to discuss the future and where we go from here with Eurasia President Ian Bremmer. That's an interview you do not want to miss.
But let's begin here with a quick check on the markets. I mentioned that pressure that we are certainly seeing across the board here following that hotter than expected inflation print. You're looking at the Dow off 246 points, S&P off nearly 1%, but Nasdaq leading the way to the downside, the clear underperformer this afternoon, off just about 1.5%.
Well, you down with PCE? Yeah, you know me. The core personal consumption expenditures, a key inflation indicator for the Fed. It rose 0.6% in January, above the 0.4% that economists were expecting. And also, the biggest rise since June. But what does it actually mean, this PCE acronym that we're talking about here? Well, as defined by the BEA, the Bureau of Economic Analysis, the index is a measure of the prices that people living in the United States or those buying on their behalf pay for goods and services. The Bureau of Labor Statistics, you know them, they produce CPI, and it's the BEA that actually produces PCE. And so we've got to go through some of the differences here between the two inflationary barometers and measures here. One of which, as we mentioned, is measured by the BEA versus the, of course, aforementioned BLS. And then this also tracks expenditures by consumers and businesses for consumers. Now, here's where it gets a little bit different. It's weighted differently by different relative performance here. And interesting to note, it tracks urban and rural consumption measures here. And so on that weighting, CPI uses consumer expenditure surveys versus PCE using data on what businesses have sold to consumers out there. Now, the Fed's battle to fight inflation is an ongoing battle. Let's listen to what Powell has said about bringing prices under control.
For purposes of this discussion, I'll focus my comments on core PCE inflation, which omits the food and energy inflation components, which have been lower recently, but can be quite volatile.
Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives.
I know what you're thinking. My brother in Christ, why does this matter here? Okay, well, the main indicators the Fed used to evaluate the level of inflation that consumers are incurring in the U.S. in an economy that is two-thirds driven by consumption, these gauges help policymakers to understand the health of the economy with relation to their own goals of price stability and maximum employment. Now, as it relates to the current economic environment, when the data continues to come in high, the Fed interprets that there is upward persistent price pressure in the economy. And in this case, they would be able to conclude that even after their efforts to enact policy that tempers inflation, more aggressive action may still be necessary. There was a trend of disinflation which had been reflected in the data of recent months before the January 2023 reading surprised to the upside. The spending on eggs could be $1 million and $2 million respectively in either report here, CPI versus PCE, yet both could still make up 1% of consumer spending because of the different totals in the respective surveys and where the data is being ingested in from. So, if you live in Colorado, you're going to be mighty envious of what those who are paying in Hawaii are getting on their egg prices right now. Shauna?
Yeah, Brad, it certainly is interesting just to take a look at where people are forced to be spending more at the grocery store more specifically. But we know prices across the board, no matter where you are, you certainly are feeling that pain of higher prices. And when it comes to the market's reaction today, a lot of that has to do with the fear just in terms of what the Fed might do over the course of its next couple of meetings, and also how high rates might stay now for a longer period of time to fight that high inflation, the persistent inflation that we clearly are seeing in the markets today. And despite despite all this, Brad, it's really amazing just how strong the consumer is. When you take a look at a number of the prints that we have gotten out recently, even today, consumer sentiment, the highest level that we have seen in over a year, income and spending growth, both coming in stronger than expected in January. So it begs the question, what recession, after we've been hearing so much about that over the last several months. Now, the consumer does remain strong, but we are starting to see maybe some cracks or maybe some fear as to what is going to come. We heard that on a number of earnings calls over the last several days. Walmart CEO Doug McMillon. We also heard it from the CEO of Wayfair, Niraj Shah. Let's take a quick listen to what they had to say on their earnings calls this week.
I think you can see it in the mixed impact. Customers are still spending money. When you think about our guidance and the place we positioned it, it's obviously not as clear to us what the back half of the year looks like as what we're experiencing right now and the momentum that we had coming out of the fourth quarter. But that's the way we would characterize them. They're making choices. We expect that to continue through the year.
We put every element of our 2023 spending plans under the microscope in order to think more deliberately about the value we were modeling for each new dollar spent and what we expect will continue to be a challenging customer environment.
Certainly seems like we are shaping up for it to be a very challenging environment here for consumers and retailers. Many of these consumer-facing names are being forced to make those tough decisions, or either cutting or reallocating some of their expenses in order to better position themselves for what could be a tough couple of quarters.
Yeah, truly remarkable what we've heard from some of these earnings calls as executives really comment on this broader economy and the consumer economy. We heard that even from Home Depot. Of course, those of you who are doing those DIY projects out there, Home Depot is still very much reliant on your dollars, as well as some of those broader construction spending dollars as well here. But Home Depot mentioning that they're trying to continue to catch greater share of the consumer's wallet. Spending on goods outpaced spending on services during the period. However, when you think about the broader economy, it's shifted from goods and back into services. That's something that travel companies love to hear. Not so much for some of the companies that are dabbling in home apparel or electronics.
Certainly is something that the travel companies have been waiting for and have been longing to hear now for quite some time. All right, let's get you up to speed on 3 things that you might have missed this week. Yahoo Finance's very own Brian Sazi here with some of the 3 big market calls that you might have missed. We've been talking about how busy of a week it's been. What might have flown under the radar here?
Real quick, I'm down with PCE, Brad. I'm not down.
Always.
I'm not down with DIY. I have no time to do that stuff anymore. But anyway, now on the Yahoo Finance homepage, I highlighted 3 things you probably missed, and really what has been a busy week for the markets. You should not have missed any of this stuff, but you probably did. I didn't miss it, so I put it in this story. First up, Jeffrey Gundlach spoke exclusively to Yahoo Finance earlier in the week. I found what he said on China potentially invading Taiwan being a black swan event, just something that caught my attention. Don't think a lot of investors are positioned for that key risk in the market. Hence, Gundlach is calling this out as a black swan event. What is a black swan event? Something that is unexpected, something not priced into stock. So that is one. Number 2, NVIDIA, guys. NVIDIA, one of the top tickers on the Yahoo Finance platform this week. Of course, Brad really crushed it in that after the call analysis. NVIDIA stock just exploded, and you have Goldman Sachs saying flat out they were wrong. In hindsight, we acknowledge that a decision to remain on the sidelines in anticipation of a pullback in the company's fundamentals was wrong. They came out and upgraded shares of NVIDIA. Now, as a former analyst, I never admitted when I was wrong. And if I was still an analyst today, I still wouldn't do it.
It takes a big person to do so.
It takes a big person. So hat tip to Goldman Sachs for acknowledging that they were wrong on NVIDIA. And last but not least, and this is a look forward to next week, this is Tesla Investor Day, March 1st. Our very own senior auto correspondent, Praz Subramanian, will be manning the webcast for this one. A lot of interesting things could come from this Tesla Investor Day next week, notably software upgrades, a new Master Plan 3 from Elon Musk. And given how unpredictable Elon Musk is, he might just come out and lift guidance. Who the hell knows?
Yeah, I don't think anything's off the table when it comes to Musk. It certainly has just been incredible, the ride that we have seen for Tesla stock, not only over the last year or two, but really even what we've seen over the last 6 or 7 weeks since the start of the year. The gains that the stock has already posted, it's incredible.
Well, a lot of those gains, I would argue, Sean, came on the pullback of yields. Now you see yields rising again. You've seen Tesla stock come under a little bit of pressure here. I think Elon has to deliver something big here. I would also just like to see, give me a date on when the Cybertruck is going to hit the market. I see these teaser videos on Twitter. It looks cool. When are these things being shipped?
I'm not sold.
No, when are they going to ship these? When are you starting to make money? And then ultimately, what is coming next from Tesla?
Yeah, certainly everyone wants to know a little bit more information about that. Saz, thanks so much for sticking around on Friday for us.
Thanks for having me. I appreciate it.
All right, we are just getting started here on Yahoo Finance Live. Coming up today, marking 1 year since Russia's invasion of Ukraine. We will discuss where we are today and where we go from here with Eurasia President Ian Bremmer. That's right after this break. Plus, the state of travel. Airline prices are spiking ahead of the spring and summer vacation seasons. So how should you best plan for those vacations that you might have? We will be joined by the CEO of Booking Holdings later this hour. And a pickle of the month or a taco a day. Which subscription would you ditch? Which are just ridiculous? And which serve the best for your buck? We're going to give you our takes and also get some of yours. We got a Twitter poll up right now. Weigh in. That's all coming up here in the next couple of hours. Stick with us. The U.S. announced a new $2 billion aid package for Ukraine and additional sanctions against Russian entities earlier today as the 1-year anniversary of Vladimir Putin's invasion of Ukraine. So to discuss the state of the war and also its implications around the globe, we want to bring in Ian Bremmer, Eurasia Group President. Ian, it's great to see you again today, of course, marking 1 year since Russia's invasion of Ukraine. Just give us a sense just in terms of your assessment of where things stand today and what we could expect maybe to play out here over the next several months.
Where things stand today is the United States has held a coalition together very strongly, both to support Ukraine as well as to punish the Russians. We've got, hundreds of billions of Russian assets that have been frozen, 10 rounds of sanctions from the Americans and Europeans, all 27 EU countries aligned and voting in favor of every single one of those rounds, in addition to the UK, the Canadians, the Americans, all on board with these sanctions, and a massive amount of support for Ukraine militarily, starting with a lot of intelligence and training and going all the way to advanced artillery and heavy tanks. So that's where we are right now, and that together with the Ukrainian courageousness and the leadership of Zelensky has allowed the Ukrainians to take some of their territory back. About 17% of their territory is presently in the hands of the Russians. That's where we are today. And of course, the economic implications of that for the world have been significant. You've had big costs on the Europeans in getting away from Russian energy. You have even bigger costs on the developing world for paying for fertilizer and food and energy in that environment. And of course, the worst costs are being paid by the Ukrainians every day, over 8 million refugees over the course of the year, more than 50% under the poverty line compared to 18% before the war started, and that's not getting better anytime soon.
How has the Russian invasion of Ukraine, from your perspective, reshaped the trajectory for a global economy here?
Well, I mean, it's been on top of the pandemic. What it's done is it's made the world less aligned. It has led to more fragmentation, less globalization. Now, part of that is cutting the Russians out of the G7 economies. And Russia's only 2% of global GDP, but it's a very important producer of major resources around the world that the world needs. And that means that those supply chain disruptions has hurt the global economy. And again, it's particularly a problem. It means that the European recession, relatively mild, but still a more challenging rebound post-pandemic than they otherwise would have experienced. But this is really a problem for potential economic crises of those countries, the poorer countries that are not commodity producers themselves, that have dollar-denominated debt and are having a really hard time making the social contract work for their own populations. That's been the biggest knock-on economic implication.
And Ian, when you take a look at where we are today, it doesn't seem like we are anywhere close to this maybe potentially being over. Do you see any sort of improvement on the horizon or any likelihood that this situation is going to change anytime soon?
No. First of all, wherever the war goes on the ground for Ukraine, the Russians will be in meaningfully worse position than they were before the war. They will be treated as a pariah by the U.S. and by American allies. And that means that Russia becomes the most powerful rogue state in the world, kind of like Iran for the Middle East. Russia will be for NATO. And that will mean espionage, disinformation, cyber attacks, fiber, pipeline, maybe even terrorism. And, Putin's not going anywhere. So dealing with Putin, leading Russia as a proximate threat, as a true enemy, is something that especially frontline NATO states are going to have to deal with for a generation, no matter what happens on the ground in Ukraine. Now, Ukraine itself is an interesting question because they do want to engage in a new counteroffensive, probably in April or May, but a lot of that depends on ammunition. The Americans don't have enough ammunition to give them, and the U.S. is not creating a war economy because no one's going to pay these companies in the U.S., the military-industrial companies, to invest enough that it will make sense. That have to be 5-10 years of war going on, or some guarantees that people are going to still buy this increased production. That's not happening. So the Americans are running around the world trying to basically scare up more ammunition for the Ukrainians. We'll see how successful they are. And that will determine when this counteroffensive will occur and how successful they're going to be. So I think there's a big open question about where the Ukrainians end up over the course of the spring and summer. And then, of course, whether or not the West will stay coherent and as supportive of Ukraine as we look forward to 2024, that's a more open question than it was 6 months ago. Also, what the Chinese are going to do as they're announcing their peace plan that is supported pretty much by the entire developing world, that's an interesting question as well.
And so that kind of dovetails into the very question I was going to ask you, which is, it sounds like any new Russian offense would also have this caveat of what role is China playing within that Russian offense as well? And from your perspective, the different lines that would have to be drawn from other entities around the world, other countries that very much deal with China, but have also had to take their own stance. And that's been detrimental for both parties.
Well, I have a hard time believing that the Chinese will provide military support for Russia directly, especially after the red lines that were very clear from the U.S., from the U.K., and from NATO over the last few days. And that was very coordinated by those leaders. I don't think that China trying to get their economy back towards significant growth is going to take that risk, at least unless they think they can do it and not get caught, which is part of why I think there was such a strong public statement by the Americans and allies, is they want to make sure the Chinese understand that if they think they can send it covertly, the Americans are going to find out and they're going to make that very known. So that's what was going on there. But the broader peace plan that Xi Jinping put forward yesterday, I want to be clear, that could have been written by India. It could have been written by any developing country. They are almost completely aligned in what they're calling for, nominally supporting Ukrainian territorial integrity, but wanting an end to sanctions, which have hurt the global economy and hurt them, wanting a ceasefire. And they want a ceasefire even if that means you've got to negotiate over land for years and years and years in a way that is inconclusive. The Chinese have occupied that space in a fairly clever way because they know that the Ukrainians can't say absolutely no to the way it's been written. And Zelensky made that clear in his press conference today. The Americans don't have a peace plan of their own, and they're not about to develop one because it would undermine the Ukrainians. And so that not only puts the Chinese in a leadership role vis-a-vis all the developing world, but it also gives them a little bit of cover to start getting closer to the Russians without being seen as a rogue themselves. And by the way, now that they've put this peace plan forward, I think we will see an announcement of a Xi Jinping trip going to Moscow to meet with Putin in the coming weeks. And that is going to be something the Americans are not happy about one iota.
Yeah, and Ian, even digging a little bit deeper there, how do you think that that's going to affect the U.S. and China's relationship then going forward? Obviously, tensions have been rising, not only about the conflict and China's stance there with Russia's invasion of Ukraine, but also a number of geopolitical factors. How much worse, maybe potentially, do you see this war playing into the U.S.-China relationship right now?
It depends on what the Chinese do. I mean, if what they're doing is they stick with this plan, and they make a trip to Russia, they're engaging more economically, but they're basically in the same position the Indians are, who are much more aligned with the United States strategically, then I would say the China relationship will be harder to manage but won't fall apart. If the Chinese actually provide weapons to the Russians, the U.S., that's a break. That is a clean break in the relationship. The U.S. will put sanctions on China directly, major secondary sanctions. Many U.S. allies would follow the Americans. It might not be all of the EU. I think that would be a very difficult debate. But I think a lot of European countries, including probably the Germans, would probably follow the United States because for them, the Russian invasion in Ukraine is a very, very big deal. It's a threat directly to them. It's the end of the peace dividend that Europe has benefited from for 30 years. I mean, the United States is providing a lot of taxpayer money to Ukraine. That's definitely a political issue in the United States. It will be in 2024. But this isn't costing the U.S. economy. It's costing the European economy. They've not been spending on their own defense, despite number of U.S. administrations telling them to. Now they are. They have to. They're the ones that have to pay a lot more for energy. And they were paying more than the Americans were before that anyway, by cutting the Russians off from gas, increasingly from oil and coal as well. The Americans benefit from that. You've got, European manufacturers moving to the U.S. because it's cheaper. So I do think that the Europeans are going to take very seriously if the Chinese decide that they're going to directly get involved on one side of this war. They have not done that yet.
Yahoo Finance executive editor Brian Sazi spoke about the prospect of defending Taiwan, another major piece of this, and he spoke about this with Double Line Capital founder Jeffrey Gundlach. And just want to play a clip of this and get your reaction on the other side.
We have not been very good at articulating a stance on Taiwan, except off the cuff, President Biden has said we're going to defend Taiwan. I don't think we have the ability to do that. Where are we going to get the money from? We don't have any money.
And so, Ian, with the U.S. deploying additional troops to Taiwan, is the White House biting off more than it could chew with China?
Your guest kind of cherry-picked, as a lot of the media has recently. Biden has on no fewer than 3 occasions said that the U.S. would defend Taiwan. And in each of those speeches, he has also said that the U.S. policy on Taiwan has not changed. The status quo is the same. So for Biden, saying he's defending Taiwan is saying that the Americans are going to provide the Taiwanese weapons and training that would allow them to better defend themselves. That is U.S. policy. Policy has not changed. Now, if there were a sudden attack by China against Taiwan, would the Americans be able to effectively defend Taiwan, or would it really be destroyed? Would TSMC, the semiconductor company, which is probably the most strategically important company in the world right now, could you possibly maintain America's position on the ground in Taiwan? The answer is probably no, but China couldn't either. and this is the point, is that I think the likelihood that the Chinese would invade Taiwan in the near future, 2-3 years, is virtually zero, because they understand that they would be destroying their own critical economic interests. The point is, though, that China has a lot more influence over Taiwan than just militarily. It's not, I mean, it would be very hard to do an amphibious assault across a 100-kilometer strait without doing incredible damage to Taiwan. If you're China, and you know that Taiwanese businesses and the economy is vastly more dependent on you than any other economy in the world, you use that. You squeeze Taiwan economically. You basically enforce more integration of Taiwanese business leaders into the Chinese Communist Party, or else they will not have the benefits of the same level of market access to China. The Chinese have so many levers they can deploy well before we start talking about U.S.-Chinese military confrontation. Those are much harder for the Americans to respond to, frankly. The U.S. is the global military superpower. If we want to threaten to blow up the Chinese, we can. But if you want to talk about economic statecraft, state capitalism, industrial policy, these are areas that the Americas just frankly don't have the same level of strength and ability, especially not in Asia, as the Chinese do.
Well, Ian, how would you grade, or I guess how would you advise in the Biden administration just in terms of the handling of these relations? Clearly, the two sides have been at odds now for quite some time. Tensions are rising. Is President Biden and his administration involving themselves then too much with Taiwan?
It's funny, you know, the U.S. policy towards China hasn't changed much between Trump and Biden. In both cases, it's pretty chippy. Trump put a whole bunch of sanctions on. Biden hasn't taken them off, the tariffs, I mean. Biden is focused on more building out American semiconductor capacity and export controls on China. Chinese going to have to spend a lot of money on that. Taiwan policy hasn't really changed. I think the constraint here is that, you know, when you leave the administration, you start talking about the media, you talk about Congress, Democrats and Republicans. They're very strongly opposed to China. And when anything happens publicly, whether it's Pelosi, former speaker, going to Taiwan, or it's a balloon going across the country, you know, everyone is loaded for bear. Everybody wants to say, okay, what are you going to do to beat on the Chinese? And that makes it hard. It's easy to beat on the Russians because the Americans don't need the Russians for anything. I mean, Russia doesn't provide energy or, you know, virtually any goods that are useful aside from really good caviar and really lousy vodka to the United States. But they're not all that critical. Uranium's pretty important, and we're still actually doing that business. More broadly speaking, you kind of need the Chinese for everything. They're massively integrated with the U.S. economy. A lot of U.S. corporates are doing big investments there. And of course, a lot of American goods that we buy are made in China. And you're not about to tell people shopping at Walmart that you need to spend more on top of inflation that you're presently dealing with because you got to buy American everywhere. So given that reality, there are significant constraints. There's a floor on what the U.S.-China relationship can look like unless we all want to start cutting off our noses to spite our collective faces.
I think we can all agree that the best vodka is actually made in Austin, Texas. That is Tito's.
Tito's is outstanding.
There we go. Ian, while we have you here, one other major item that we want to talk about is the fact that we've seen so much mention about artificial intelligence, and that has certainly been the buzzword of early 2023 year, flowing over from 2022. And you've heard it time after time again on earnings calls. It's showing up in policy leaders' discussions as well. What role do you think artificial intelligence will legitimately have as we're trying to get footing in terms of how it'll play out a role in our everyday lives?
Well, the role we'll see in our everyday lives first is it's going to create a lot more productivity. There is a lot of low-level creative work that can be given to these new generative AI bots and apps that will free up creative employees to be more effective at their jobs. You'll see that among illustrators. You'll see it among editors. Now, of course, as that continues, you might start to see a lot of jobs getting displaced. So there's an open question, but there's certainly productivity gains there. There are massive productivity gains in efficiencies as you can use AI, explosive AI in, for example, deployment of fertilizer more effectively around the world to ensure better production of agriculture, in reducing deforestation and knowing exactly where it happens. Just getting real-time information on the state of the planet, and therefore being efficient in the resources you deploy to get better growth and fewer losses. AI makes that happen. So I'm an advocate, I'm an enthusiast when it comes to the productivity and efficiency gains that comes from AI finally being a hockey stick. But there's also the reality that bad actors will have access to these technologies in very short order, and they will use it to promote disinformation. And I'd be deeply concerned if 3 years ago we had already had these generative AI tools and they were used by people that wanted to ensure that anti-vax sentiment was promoted. We'd have a lot fewer people getting vaccinated, a lot more people dying from COVID as a consequence. We'll see that in elections going forward. We'll see it with authoritarian states using it for propaganda purposes. We'll see it in the next meme stock, GameStop explosion, where instead of a bunch of Yahoos, pardon the pun, on Reddit, you're going to see sort of thousands more bots being driven very effectively, very credibly by AI. So I do think that there is a great deal of danger, especially for civil societies going forward, and at a time when the social media companies have just fired so many of the people that are responsible for trying to ensure that there's a level of coherent and believable content on their sites.
Ian Bremmer, Eurasia Group President, joining us here. We always appreciate the time and absolutely value the insights and analysis that you have time after time. Thanks.
My pleasure. See you.
All right, guys, coming up, movie theater earnings enter the spotlight. We'll tell you what Cineworld's latest report could mean for AMC, which reports next week.
It's time for a triple play. 3 stocks that we're watching in the final half hour of trading. We've got Beyond Meat, Cineworld, and AMC. Kicking it off with Beyond Meat. It's a top trending ticker. It's been the case all day here on Yahoo Finance. We're looking at a gain of just about 11%, the biggest single day gain that we have seen now in quite some time. The rally is because of its Q4 sales beat and also that smaller than expected loss. Now, despite the pop that we're seeing in shares today, analysts aren't fully on board with Beyond Meat going forward. Rather, the roundup on the street seems to be cautiously optimistic at best. So there are still no buy ratings on Beyond Meat right now. Some analysts, though, did raise their price targets following these results. Bernstein upped its price target to $18 from $10, while UBS raised its target to $17 from $12. Piper Sandler remaining bearish, noting that the sales of its jerky business, which it recently launched, is hiding a greater acceleration in sales here to the downside across the rest of the company's portfolio. Obviously, a cause for concern here. We know Beyond Meat has been a pretty volatile stock as of late. The pop today, though, and the results that we just got, not enough to convince many on the street that this is a stock to buy at this point.
I'm surprised there's an 11% gain, because let's not forget, year over year decline in revenue of 20%. Yeah. So this is a company that is not growing. I will say anecdotally, when I do go to my grocery store, I see the Beyond Meat packaging, but in terms of the excitement around alternative meat products, that has definitely faded over the past few months. Definitely not what we saw a few years ago. So I think this is a sector that saw insane amounts of growth, and now it's not getting the same attention. And I wonder if that's going to really hurt them when they're trying to do these other partnerships.
Yeah, some of the analysts that remain bullish on Beyond Meat, quite frankly, might just be high on sodium right now, because if there's anything that you look at within this earnings report, which was lackluster, sure, it beat on some of the expectations that were already out there, but look across the category. It's a Beyond Meat company that has meat in its name, that, yeah, saw slumping sales in its meat as well, in every single category regionally. And then the beef jerky, even, if you're looking at the upside there, guess what? They just restructured that business. Yeah. So all of that considered, I am not certain which consumers are going to continue to opt to pay higher for a Beyond Meat offering, whether that's for the fridge or whether it's in a restaurant experience, especially as they're tightening some of their own costs.
Yeah, and also just the competition, the sheer competition in this space has been heating up. So many traditional players getting in to that line of business, the meat alternatives there. So it's a tough road ahead for Beyond Meat.
Yeah, and if I'm going for jerky, I want the real thing. I don't want any fake meat. I want the real thing.
Some of the options are good. I'll give you that.
That's true. But from one beaten down sector to another, my triple play today is Cineworld. And boy, guys, is it a rough one. Shares are plunging after the theater chain revealed it had received no all-cash offers to save the business. The company saying in a statement, quote, based on the proposals received to date, it is not expected that any sale transaction will provide any recovery for the holders of the company's equity interests. So not good news for shareholders. Cineworld is sitting on about $6 billion worth of debt. Shares closing down 43% on the London Stock Exchange. And guys, it just feels very hopeless for this company at this point.
Yeah, it was interesting because even as you started to think about some of the locations that were primed for even closing along that movie theater operators' kind of lifestyle and lifetime here, we've seen them be able to welcome so many people into those experiences, but the pandemic actually absolutely ruptured that experience for a lot of moviegoers, and now it's on the back of so many different titles that Cineworld, that AMC, Cinemark, all of them are trying to bring moviegoers back on, even IPIC as well, which I've only paid an IPIC premium one time this whole year, and I think I've gone to see more than the average amount of movies over the course of
I was gonna say, do you go a lot?
Like once a month.
All right, I have yet to be back since prior to the pandemic, so I'm the outlier there. But I do think just looking across the board, looking at the box office sales, Allie, I know you closely track that. Outside of some of the huge blockbusters, we haven't seen much of a reason to go to these theaters. So if you're in that line of business, obviously a number of those companies continuing to suffer right now.
Yeah, and well, AMC is another one that we've been keeping close tabs on, as well as the apes out there. And they're going to be reporting earnings next week. One thing to remember with this company, of course, is we're taking a look at the share price action here on the day. It's blockbuster films like Avatar: Way of Water that I had ultimately said when it came out I wasn't fully impressed by, because look, I'm not an Avatar fan. I got dragged by some of the apes that are out there and big fans of AMC, but the movie has been doing great, and with the performance that it's seen at the box office, there's no flies on that. We're going to see how it's helped the world's biggest movie chain, AMC, when it reports on Tuesday of next week. Tuesday of next week?
It's just amazing looking at some of the price action that we've seen in AMC, specifically since the start of the year. And we know a lot of these meme traders, the retail traders, have come back in here, getting a little bit more excited about AMC. It's totally trading. Obviously, this has been the case now for quite some time. It has nothing to do with the fundamentals of the company. So when you see so many retail investors, retail traders getting excited about AMC with the lack really of any of that story changing on a fundamental basis, it's still hard to wrap your head around and really make sense of the action that we have seen.
And the passion of these apes.
Oh,
If
yes.
I say anything remotely negative about AMC or the theatrical experience, I get attacked on the Twitter. So, but like you said, it's a meme stock. You have to be careful. It doesn't trade on the fundamentals, but. But people, the shareholders, they're very intense.
Yes, AMC shareholders, we love movies just as much as you do.
We love them.
Yes. Coming up, everyone, Booking Holdings trading higher after its fourth quarter revenue increased by 36% thanks to strong demand. We're going to speak with Booking Holdings CEO Glenn Fogel on the other side of this break. Let's take a look at the state of travel. It has not only rebounded, but gone past pre-pandemic levels, according to data from the travel app Hopper. Prices for round-trip flights this spring are up 20% from a year ago and 5% from 2019. But rising prices aren't killing demand. One company benefiting from the travel boom is Booking Holdings. And joining us now, we've got Glenn Fogel, the CEO and president of Booking Holdings. Let's start with your earnings report from last night, Glenn, because we were breaking it down for some of our viewers here after hours. You got to walk us through some of the biggest catalysts that are really the beneficiary, or that Booking Holdings is being the beneficiary on top of right now.
Well, thanks for having me. And obviously, we are very pleased with how we reported last night. And even more so, very pleased to talk about January and how travel is still going strong.
Yeah, Glenn, tell us a little bit more just in terms of the trends that you are seeing in January. I know you were saying that has remained very solid. Obviously, you are going up against what could be a tough macroeconomic environment. Are you still seeing that carry through? And I guess what risks maybe do you possibly see ahead?
Well, we talked about this last night, where we're not seeing any of our customers who are downgrading for a lower star rated hotel, or we're not seeing them shorten the amount of time they're spending, the length of stay, as we call it, remaining this strong. So we really are not seeing any indication that this potential future recession is dimming the desire of people to travel right now. It may happen, but I see a lot of various opinions about the economies going down the future, and we'll see how that plays out. For now, people want to travel.
What we've heard from some of the other CEOs and some of your competitors included here on Yahoo Finance is that the international traveler, and particularly a traveler coming out of or originating from the origin travel from China, now that that's opening up a little bit more, what are you seeing on the international front?
All right, so a couple things we want to unpack here. So last year, 2022, we had a record number of room nights, really great numbers. And that was done despite the fact that Asia, for most of the year, was not fully open for travel because of the COVID pandemic restrictions. China was totally shut down, and we still did great. Now, here's the thing. Pre-pandemic, we weren't a big player in China. We were bigger than any U.S. or non-Chinese player in that country, but we are still very, very small compared to some of the Chinese players. So when somebody outside China starts talking about China is going to be a big difference to their business, that's not true. We hope that we'll get a larger share of Chinese outbound when it comes back. It's not back right now. It's going to take some time for it to come back. It's not going to be easy. It's a very competitive market there. We are very encouraged, though, by seeing how Asia now, having started to open up in the fourth quarter, really opening up towards the end of it, is going to be a tailwind for us in 2023. So that's something we can look forward to.
Glenn, what are you seeing just in terms of the booking window? How far in advance are people booking their trips now?
Yeah, it's interesting. So we talked about that, how in the fourth quarter, we saw that the booking window was shorter than it was in 2019, but we reflected on how in January it flipped, and now it's further out than it was in 2019. What that indicates is that people are feeling confident about booking for further out travel, and that's a great thing, showing people more confident about their futures and about perhaps the world in general.
Glenn, what about competition? You're obviously in a very competitive space. There are a number of companies out there saying that demand has been very strong for them. What are you seeing just in terms of what differentiates your platforms compared to what else is out there?
Yeah, no, and people are always coming to us saying, how are you getting all this, share gains, particularly in very competitive areas like the U.S.? We talked about that. We have been gaining share in the U.S., and it is very competitive. I'm sure you travel. I'm sure you're tempted to look at lots of different sites, and why would you book with us versus somebody else, let's say? And it really comes down to any type of consumer business. You got to provide a great product, great service, right? Give them value, and then they'll come to you and use your service, and they'll come back to you time and time again. That's really what we're doing. And people say, what's the silver bullet? I say there is no silver bullet. You just got to be grinding it out day by day, providing better service, more value, and that's how you can make that work in the long run. That's what we're doing. And you look at our results, look at the record numbers we're pushing out. That's what's proven that we're doing the right thing.
No silver bullet, but do you believe that there's a role that AI plays within that booking experience in the future?
Yeah, quite the topic of discussion over the last few months. It's interesting how that happens, where something that's being worked on for a very, very long time. Look, we've been working with AI models and using AI for maybe 20 years. And of course, before that, AI had started, but it's only until something like consumer awareness from ChatGPT or something comes out, and all of a sudden it's the buzzword of the day. Look, AI is very important to everything we do in our society right now, has been for some time. And people who may be not aware of how much AI plays part of their lives, they just didn't know. It's going to become even more so. And we know that. You look at the productivity curve and how it takes time for a new technology to take effect and actually change the way people work or the way people do things. And we're starting to see that just begin to really ramp up. So I'm pretty excited about it. And one of the things I like is the fact, look, we got a center in Tel Aviv that's an AI center. We've been working with universities for years in AI. We are pretty excited about what the future could be, albeit it will take time. We're not going to see some great, gigantic change in the next 6 months, I assure you that.
We are excited to hopefully have you back here in a little bit and talk a little bit more about how AI is playing into your business, how you see it really revolutionizing your space in the coming years, it sounds like. Well, Glenn Fogel, great to have you, Booking Holdings President and CEO. Coming up, market volatility has rocked 401ks, with some seeing their values drop by more than 20% last year. We'll tell you how to best navigate your retirement savings through these tricky times next.
There we go. You trying to learn something, pretty girl? Yeah. There we go. All right, so let's talk about a cheat code that we can do, right, that other parents can do to establish what we'll say one step of generational wealth for their kids moving forward. We got to be aggressive with our savings and more aggressive with lowering expenses. You're going to have over 59 years of compounded interest that is growing and accruing every year tax-free.
That is Ross Mack, who provides retirement and investment advice on TikTok and is the creator of Revolt's Macnomics. On today's installment of Retirement Ready, brought to you by Fidelity Investments, we take a look at how to think outside of the box when it comes to setting yourself or your children up for retirement success early on. But recent economic conditions have challenged Americans, according to Fidelity. The average balance in a 401k plan fell by more than 20% last year. Ross Mack joins us in studio now. Let's just get to the man himself. So we got to navigate the latest conditions here that have really kind of stirred up a different set of criteria or parameters for how someone can really get themselves into retirement planning here too.
Yeah, well, one, thank you guys for having me. And I think obviously the overall economic backdrop, the uncertainty obviously is rocking the overall stock market. And as a result, that's going to negatively impact people's retirements. Obviously, Fidelity reported yesterday saying it's down over 20%. But the reality is when you think about your retirement, this is your long-term savings account, effectively, that's compounding more aggressively. So the reality is if you're not in an imminent danger of actually necessarily needing this in the short term, there's no reason to actually touch it. So when I look at, a person saying, oh my God, what should I do with my 401k? Or what should I do with my Roth IRA? The short answer is absolutely nothing. Assuming, right, you made a very strong, diversified approach when it comes to allocating.
Ross, I got to ask you, were those your kids in the video?
Yes.
They were so cute. I loved it. I could have watched that all day. Ross, let's talk about what people need to do, because I think a lot of people, when they think about retirement, they get overwhelmed very easily. They don't know the best ways to go about it. If you were to give maybe one piece of advice or a starting block to those out there, what would you tell them?
I would say one word: start, right? I think what happens is a person, they start saying, okay, I don't know what to allocate. Do I go with those 3 letters or these 3 letters, right? As an IRA, do I use my 401k? At the end of the day, when you really look at what you have, time is on your side. However, the younger you are, it's best to actually start. So a person that's in their 20s, if they start investing, putting a few $100s aside every month, in 40 years, they'll have well over $1 million, right? Assuming, a lot of other factors. But the idea is you have to start. And I think when it comes to retirement, you really have to say, I want to pay my future self, right? I want to be disciplined today in order to live a better tomorrow.
We just saw data come out from the New York Fed recently that showed that household debt is continuing to increase and actually surpassing some pre-pandemic record highs as well. And not all debt is bad debt. Of course, people who are paying down home debt, for instance. But you've also got the credit card consumption that's going up. So all that to say, at a time where people are looking across where they're taking on more debt, how can they continue to prioritize savings to make sure that they still do hit some of those retirement targets?
It's unfortunate, right? When you look at those statistics, it's obviously stemming from the fact that inflation is so rampant right now. The latest report, it doesn't look like it's slowing down at the pace we want. And so as a result, people are dipping to their savings, right? We've seen savings rates down, consumer debt much higher. But at the end of the day, when it comes to prioritizing, you have to continue to say, how can I live below my means? A lot of people sometimes live over, and some, when they're being good, they're living at their means. But I think living below their means, and how you do that, well, you start, what are the subscriptions that I can cut back on, right? If you are prioritizing saying, no matter what, I want to retire a millionaire, so therefore I need to be putting $250 or $300 or $400, whatever that number is that you can afford, but you have to look at it and say, you got to write it down. It's a budget, right? Everything starts with a budget, and when you're really saying, okay, I want to retire a millionaire, this is how much I need to invest on a monthly basis. Now I'm saying, what do I need to cut back in my life in order to make sure that that's one of the last things that I'm going to cut back on?
And Ross, one of your videos gets hundreds and thousands of views, and I know one of your missions is you want to help close that wealth gap. What have you done? And I guess, are we seeing any sort of progress in terms of some of the feedback that you're getting from your very avid watchers and listeners?
Yeah, when you really think about the systemic problems that, when we think about why there is a wealth gap, one of the things that I say, you can only control what you can control. And one of the things that I'm able to control is helping bridge the information gap, right? There's a huge exposure gap. And obviously financial literacy isn't taught in our schools, right? I learned a lot of stuff. I went to some great schools, but nonetheless, how many of the things are actually applicable, right? I want to know about retirement. I want to know about buying a home. I want to know about credit scores. And so what I do, I use my platform as a way to actually bridge that information gap. And what I'm doing is saying and obviously you showed some of the stuff, if I'm showing people in the world, I'm talking to my 2-year-old, I'm talking to my 1-year-old. And the reality is financial literacy is a language. And so therefore, the earlier you learn how to speak it, the kids will then, subconsciously start taking that in. And so when I think about my mission is saying, I want to help change a life, every day, right? Through some new form of saying, oh, wow, maybe I should start investing. Oh, wow, this is how I improve my credit score.
Creator of Revolt Maconomics, Ross Mack, joining us here on Yahoo Finance in studio. Thanks so much for taking the time, Ross.
Absolutely. Thank you guys for having me. It's a pleasure.
And coming up, we are counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live.
Let's take a look at where we are here in the final minute of trading. All three of the major averages under pressure following that hotter than expected inflation print out this morning. We know that is the inflation gauge that the Fed prefers. So that's adding some pressure here to the markets in terms of what maybe that means for that Fed policy will look like over the next coming meetings here. But you're looking at the Dow off 351 points, S&P off just about 1%, the Nasdaq off now over 1.5%, down 1.7%. So some of those losses accelerating here in the final minutes of trading. You're looking at the worst week for the Nasdaq since December and worst week for the S&P since December as well. Here's the closing bell. All right, well, that wraps up the trading week. We're ending it on a down note here. Certainly a week of losses as you look at today's losses. Dow closing off 351 points. S&P off just about 1%. The Nasdaq off 1.7%. Some pressure on the markets here following that hotter than expected inflation report out this morning. The Dow having its worst week that we have seen since September. Let's narrow in on some of the notable earnings reports from this week. We know investors are keeping a very close eye on some of these reports. We got to kick it off with Carvana. We're looking at losses today of about 20%. The selling coming after the company disappointed with its quarterly results, sending shares sliding today, triggering a list of warnings here from analysts. Despite today's sell-off, though, the stock's still up over 70% since the start of the year, rebounding from that brutal 98% drop last year. And Brad, when you take into account the report that we're getting out here from Carvana yesterday, certainly a lot of red flags, a lot of it having to do with its mounting debt. It's going to be very, very tough to navigate what is looking like is going to be a cooling used car market, given the fact that consumers are pulling back on their spending. And the street seems to be a little bit concerned about what the next several quarters potentially are going to look like for Carvana.
Yeah, absolutely. There were a ton of red flags within the report. One of them was certainly the average amount that they're profiting on each vehicle, and then additionally what consumers are willing to pay right now. You were looking for much of 2022, especially for the front half, at a car market where it was almost cheaper to buy a new vehicle, if you could find one, versus a used vehicle. And so with that price comparison and the value expectation that a lot of consumers were going into that car market and that purchasing mentality on, the prevailing thought was, okay, why not try and get into that new vehicle where you could get a better ability to not just finance over the longer term, but then additionally what that servicing would look like and the agreements that you would have up front too. And so Carvana, we had continued to watch the stock over the course of 2022 and now 2023. Don't believe this bounce to the fullest extent that you've seen. And I think there's still a lot of unanswered questions that this business has to account for and has to give to investors.
Yeah, certainly. When you take a look at some of these analyst calls here, JP Morgan saying high debt, suggesting no equity value left in the stock. If Carvana taps into about half of its real estate capacity, that would bring its funds for another year. RBC slashing its price target, saying that investors will be worried about rising liquidity risk after this report. Second half acceleration seems likely, but they would expect those levels to be modest. So the street certainly pretty apprehensive, pretty hesitant just in terms of what we could potentially see from Carvana here, given all those challenges.
That's right. We're also watching shares of Block closing in the green. They closed higher, the company formerly known as Square, up by about 4.3%. This comes after the company posted strong growth in gross profit and a $484 million growth in profit for Cash App there. Now, analysts, they like this report here. We saw some analysts, some new ratings come out over the course early this morning as well. And what particularly continues to be noted, especially from Truist, they said, we appreciate ambition by, very simple terms there that they put out there, but they're believing in this investment framework. They're saying that that's positive, and they assert that the market will appreciate that commitment to an economically based gross profit retention. And then this Rule of 40 objective, you can go further into that on their report, but it implies significant improvement, at least from some of the targets that Truist had prior to this report as well.
Yeah, Jeffries, they have a buy rating, $85 price target here on Block. So about, $7 higher than where we are today. And they've said that the strong performance of the Cash App and Afterpay offset the miss that we certainly did see on gross payment volume. The miss on gross payment volume was obviously a miss, something that the street did not want to see, but still up 15% year over year. So certainly still seeing a growth in that metric, in that data print there. But subscription and services-based revenue, that jumping 70% year over year. That Cash App business reported $848 million in gross profit. That's a 64% year over year rise. So clearly up big this year. And as you can see from the stock's reaction today, the street seems to be pleased with those results.
Yeah, I'll tweet out my Cash App after the show just to make sure it still works if anybody wants to check it with me. All right, everyone, we got to talk about another retailer here on the day. Big box retailer Home Depot raising its minimum wage this week. This is all part of a larger trend that we're seeing. Brooke DePalma is here with the details. Brooke?
That's right. Good afternoon, everyone. Good afternoon, both of you. Of course, Home Depot announced in their fourth quarter earnings results this week that they are, in fact, investing $1 billion in wage increases. Now, this investment will ultimately bring the U.S. average hourly wage at Home Depot to at or above $15. That will be reflected in their employees' February 17th paychecks. Now, this is part of a larger trend, as we noted earlier, that we're seeing across big box retailers. At the end of January, we saw Walmart also increased their prices, saying that we'll begin investing in higher wage for associates. That was in a statement to U.S. employees. This will bring their new wage to $14 to $19, up from $12 to $17 per an hour. They expect from there that the U.S. average wage will be more than $17.50. That will go into effect on the March 2nd paychecks. Now, this is all really part of a larger trend, as we keep emphasizing here. Oliver Chen, Cowen analyst, calling it a no-brainer here in a tight labor market and a low unemployment rate. Of course, in January, we saw 30,000 retail jobs added, as well as an unemployment rate of 3.1%. And so with ultimately retailers wanting less turnover, of course, it's a major investment. They don't want to perhaps waste money on investing in training employees. They want to make sure that they're paying employees ultimately what they deserve and what they need to keep them.
Yeah, certainly it is important for those employees, but I think a lot of analysts, though, looking at this through what this means for Home Depot, in this case, $1 billion investment, what it means for their bottom line, how that looks here over the next several quarters. What was the takeaway there?
Yeah, well, a few analysts that I spoke to really said that this is a short-term impact. It'll ultimately impact their gross margins, perhaps in the quarters to come, but long-term, lots of value there. They're noting that short-term, we'll see an impact on gross margin, SG&A, expense pressures, but ultimately the bottom line here is that investing in your partners creates happy customers who they're seeing at the front door of these retailers, and then more value for the company. And so as far as if other retailers will invest, we did see Target last year announce a wage increase of $15 to $24 last February. But what's important to note here is that Home Depot, Walmart, even Target, they saw big opportunity during the pandemic. All three of those stocks got a boost. And so they have the money in order to do these sort of wage investors. Who this will hurt here is those smaller retailers that don't have the money to pay these employees more.
And certainly don't have the resources for that. All right, Brooke DePalma, great stuff. Thanks so much. Well, the Fed's preferred inflation gauge coming in hotter than expected last month. The core PCE price index ticking up 0.6% in January, was up 4.7% from a year ago. And that, of course, putting pressure on the market today. We had the Dow closing off just over 300 points. So for more on this and where markets are headed, we want to bring in Keith Fitzgerald, Group Principal. Keith, it's great to have you back. So certainly the market's not liking what we saw from the PCE index reading earlier today. What do you think this means here for the markets going forward and what the implications are for the Fed?
Well, you know, there's sort of a nuanced layering here. Number one, you've got to simply take a deep breath, because a lot of this kind of selling has nothing to do whatsoever with inflation. It has everything to do with the amount of leverage that's being carried. That's really where the Fed comes into play, because if the Fed wants to raise more aggressively, all of these huge traders that are levered up to their eyeballs are not going to want to carry that because it costs them more money. So they sell. So if that's the case, I think it bodes for pressure into June or so. I think the Fed might have to admit that it's as wrong about rates and labor as it was about transitory. So for me, this is an opportunity. If you got 3 to 5 years out, you take this kind of stuff with a grain of salt, especially on big down days, because that's proof, counterintuitively, that the markets are actually working the way they're supposed to.
Okay, and so for the markets that are trying to get ahead of the Fed, it seems as of right now, they're still very much behind or just not believing what the Fed is saying. So how does that course correct itself in the near term?
You know, that's an interesting one. I don't know that I have the precise answer, but that's a very insightful question. I think right now the markets will correct themselves as investors figure out that their best friends are going to be companies that are still putting up great numbers, that are still got great dividends, that are still moving forward into this market, because those are the kind of plays that you want to go for. So a company like Apple is very different from a company like Carvana. A company like General Mills is very different from a Federal Express. Those are companies that are creating value in tomorrow's world, not the world we used to live in.
So for tomorrow's world, there's a lot of hubbub or brouhaha or whatever speculation around what AI could mean for all of those companies that you mentioned. I'm still trying to figure out how Carvana is going to do it. But at the end of the day, where do you believe that the companies that are able to invest right now in some of those longer term kind of moonshots are going to be able to net out?
Well, I think that the bigger players clearly have the advantage because they have the scope and scale needed to deal with it. So obviously Microsoft is first in the water. I think they've invented a Google killer. There's some challenge there. China is going to come quickly on this. There's going to be some companies out of Europe. But underneath it all, there's going to be a company like AI, which is making GPUs, and you can't have AI without the GPU. So if you keep it really simple, it's time to buy the haystack, not necessarily the needle. Go for NVIDIA.
Keith Fitzgerald, thanks so much. Have a great weekend.
Thank you.
And Wall Street eagerly awaits Warren Buffett's annual shareholder letter tomorrow. Find out how the Oracle of Omaha amassed his fortune and what you can do to perhaps follow in his footsteps, should you so choose, when we come back.
Warren Buffett's annual shareholder letter set to be released on Saturday. The letter and what Buffett is buying, of course, is going to be closely watched by Wall Street, given the billionaire's prior investment success, a heck of a lot of it. Our own Josh Schaefer is here with a breakdown of how Buffett became a $100 billion man. How'd he do it?
So when you take a look at Bloomberg's index, it says that Warren Buffett is worth $106 billion today. Nearly all of that is tied to Berkshire Hathaway stock, which Buffett started buying at less than $10 a share in the early 1960s. Now today, one share of Berkshire Hathaway Class A shares costs about $463,000. But as Buffett's bets have grown bigger, some recent buys really stand out. Up first, Bank of America. Buffett famously piled $5 billion into the stock in 2011, and since then, shares have grown over 400%. Some thought Buffett was late to Apple when he started buying in 2016, but Apple shares have also risen more than 400% since he bought. And more recently, Buffett's been an oil man, dumping billions into Chevron and Occidental, with Chevron shares roughly doubling since Buffett significantly increased his position in late 2020, guys.
Okay, so where does Buffett stack up among the billionaires right now?
So he's not number one.
Okay.
We should start there, right? That's Bernard Arnault. He's number one, and then we've got Elon Musk at number two. And what I want to show you guys here, let's take a look at Elon Musk's net worth. See how that chart kind of moves up and down. It looks a little chaotic, right? Elon's still number two, but you can see it almost looks like Tesla's chart, right? To some extent, these billionaires, it's very tagged to what their stock does, right? And then when you look at Mark Zuckerberg's, he also shot up very quickly with Meta, but then see how much he fell as Meta's stock fell. Then when you look at Warren Buffett, the slow process, right? Buy and hold, buy and hold. A little bit more of a steady chart there, and significantly more than Zuckerberg. So that's sort of my biggest takeaway when you compare him to some of the other billionaires and maybe the modern tech billionaire, is Warren Buffett has been able to sustain, while some of these other billionaires are really pegged to one stock, one tech stock that has been a bit more volatile in recent years, while Buffett has been more consistent.
Slow and steady wins the race.
Yeah, indeed.
I always taught you that.
Yahoo Finance's own Josh Schaefer breaking down all things the Oracle of Omaha. Buffy the stock market slayer here on the day. Thanks so much, Josh. All right, well, Warren Buffett's shareholder letter on Saturday will certainly detail Berkshire Hathaway's top holdings, including Apple, Bank of America, Chevron, American Express. The list goes on. Oh, yeah, Coca-Cola. He's probably sipping one of those right now. Those 5 companies, yeah, we know they make up about 75% of their holdings. Let's dig into this portfolio a little bit further with Lee Munson, Portfolio Wealth Advisors, President and CIO. Lee, what do you expect to hear from the Oracle of Omaha when, my gosh, at the ripe age of what, 97, 98? 92. It's Charlie Munger that
We're adding
is
5 years to
99.
his life.
Yeah, exactly. What do you expect to hear when Warren Buffett takes the stage?
Well, he likes to do these old yarns about, that he's just this like kind of old homespun guy and how, he has a mission at Berkshire Hathaway. But I think that what Wall Street's really looking at, because every year, like I've read every single annual report for, 40 years, right? And I reviewed the last 30 years last night. And it's just, they're the greatest stories of Wall Street that were ever told. And I think that Wall Street, though, is looking for his opinions about things like energy and what he's doing with his energy holdings. I think I want to hear about what type of firms he's acquiring and in what type of sectors. Remember, this is a guy who has made his money on, number one, I think what everybody has to understand is that he has these cash machines and he has to get this cash working. Right. So early on, he's very famous for buying See's Candy, and he bought it for, a few $100 million. And then what's happened is that it's paid out over $1 billion in cash flow, and he's used that to acquire other things. The big one that nobody talks about is Geico. Little known fact, he started pitching stock as a stockbroker, just like me, but it was 1951. He was 20 years old, and his first pitch when he became a stockbroker, which he was miserable at, was Geico. And then basically in 1980, he bought about half of it. In the early 90s, around 95, he bought the other half. Now, the thing you have to remember is that Buffett makes all this money off of insurance. And I'm really interested to see how much money Geico's been making just because of COVID and all these things. And that's a little bit inside baseball. But remember, that free float that he has, it basically gives him access to capital at no charge, right? Because he's investing these policyholders' money, the extra float, and then he's really good at investing. So it's just money upon money and upon money. I want to see what he thinks about the general economy, but I'm just going to tell you, you're never going to get that great answer for him because in his mind, he's buying companies for such long term, you're going to have to really, you're not going to get something that is going to give you actionable trades tomorrow. But I have my eye on Berkshire Hathaway Energy, BHE. That's where he puts in all these oil companies that he's been buying. That's why you don't see like dozens of oil companies in his stock list, because he buys the entire companies and then folds them in. And I want to see what those projections are and see what kind of color that we can get to that. And come on, every weekend this comes out. Anybody who's worth anything on Wall Street is going to read that annual letter, right? And for any of the kids out there listening, if you haven't read all of his annual reports for the last 30 years, don't even talk to me because you know nothing, right? But I also think that you have to know when to sell, and so I'm interested in that. Remember, you have to be willing to do new things, even if it blows up. Warren Buffett is not just a one-trick pony. Back in 2016, he was in there. He bought a bunch of airlines, and he said specifically in reports in the 80s, "I'll never do it again." In fact, he joked about having a hotline set up just in case he wanted to buy an airline, and he'd call this number, and they would talk him down. But he did that. Now he blew him out in 2020 for COVID. That didn't work out very well. But in 2016, he also bought Apple, right? And that was something he said, "I'll never do because I never buy tech companies because I don't understand them." But lo and behold, he said, "Oh, Apple's not a tech company. It's a consumer product with, you can raise prices and people will take it." So I'm looking for some more information about any new companies he's looking at and what he's trying to look to acquire. I want to see how much cash Berkshire has. So those are the typical things. And it's just, you come in Monday, and then, it's the beginning of the rest of your life after you've read that annual report.
All right. Well, I couldn't sum it up any better. You certainly have made a compelling case, Lee, that everyone out there should pay attention, should read the shareholder letter that's out tomorrow. Lee, let's talk a little bit more about Apple. You mentioned the fact that Buffett bought that in 2016. Apple now represents about 40% of his portfolio, the top holding there for Warren Buffett right now. From your assessment, just from your point of view, do you view that at all as a risk that he has that he has such a large holding in Apple?
No, Warren Buffett likes concentrated positions, right? He plows money into things, and that's how you get rich. I'm not concerned about it because he believes that it has this moat, Now, I'm not saying that means you should go out and buy Apple. It means you should have gone out and bought Apple in 2016. But, my day-to-day job now is about preserving wealth for clients. My clients are like over 60 and retired. But if you want to create a lot of wealth, you've got to find good companies and you've got to hold them. He paid $11 million for Washington Post and blew it out for like over $1 billion many years later. He bought Coca-Cola once, back in 1988 after the '87 crash. And just think about this. He gets $750 million worth of dividends every year from Coca-Cola, and he's up 20 times on it. So when you're looking at these big concentrated positions, that's just a outgrowth of where his confidence is, where he thinks money should be allocated, and that's what he's all about. And I think it tells you that he feels that he wants to have that money in Apple, but also he's had other big winners where he'll go to sell it. And I'm always looking at when he's going to sell and what he buys with it. He bought Gillette back in the 80s, became Procter & Gamble, and it was this huge position that he had, and he blew it all out to buy other stuff. And so it's not so much how big the positions are, but when you see him start selling it and buying other things, that's the tell. That's like at the poker table, and that's when you really want to pay attention.
Yep, well, his track record certainly says it all. We, of course, will be closely reading that shareholder letter. We'll have all the angles for you covered here on Yahoo Finance. Lee Munson, always great to have you. Thanks so much.
Thank you.
Well, coming up, people who have been laid off from some of the big tech companies are trying to figure out their next move. That's some. Others, though, are already starting their own businesses. We're going to tell you all about it when we come back. And whether we get a soft landing, a hard landing, or no landing at all, see what President Biden needs to do to spin the inflation fight to his advantage. We're going to have all that for you when we come back.
Doesn't matter if it's a soft landing or a hard landing. It doesn't matter. People are always asking me this question, how bad the recession's going to be. It doesn't matter. As long as we're going into recession, you have to have a certain degree of protection. The stock market is in a protracted bear market. Inflation is going to be reluctant to come down. The CPI is such a strange construct because it doesn't really apply to real life. Who buys a new car every month? Historically, when you get more than a 50 basis point rise in the unemployment rate, you've never avoided a recession. So the Fed themselves are sort of predicting a recession themselves.
What do you think is the biggest risk to investors looking out over the next few months?
Ukraine war is a problem for the future because we're depleting our munitions and we're wasting money on it, which is just another piece of the whole budget problem. I think Taiwan's the bigger problem.
Last year you said the 2024 presidential election is barreling down the tracks. Fasten your seatbelts.
Markets don't like uncertainty. We're not far away from a presidential election that nobody wins the Electoral College. All you have to do is read the news, read two opposing news sources, and clearly they're watching two different movies.
Is the potential black swan event in markets this year, everything tied to the debt ceiling, how that turns out?
I think the debt ceiling is just a straw man. We don't have any money. We're running a huge budget deficit. It's still a massive percentage of GDP. And don't forget that zero interest rates really helped keep that deficit down. When you have this sort of attempt to never have a significant downturn in the economy, Fed to the rescue, zero interest rates, quantitative easing, what you're trying to do is avoid any type of hard landing ever. But that type of activity violates Gunlock's rule of financial physics.
What's the answer?
The answer is you have to raise the age on these entitlements. People don't need to retire at 65. They don't need to get entitlements at 65. They should needs test them, and at least that would stop the balloon from getting blown up bigger to the point where it's going to explode.
Two things have dominated tech news in 2023, AI and also layoffs. According to layoffs.fyi, over 110,000 people have lost their jobs just in tech this year. With a closer look at what's happening and also with the moves that some of these talented people are making, we want to bring in Natasha Mascarenhas, a TechCrunch senior editor. Natasha, it's great to have you here. So certainly it seems like day after day, we're getting these headlines of these tech companies forcing to make that tough decision, eliminating some positions there from their companies. You've been tracking what some of these former employees are doing. What have you found?
Oh my gosh, it is so good not to be talking only about the doom and gloom when it comes to layoffs. What I'm happy to report is that some people are using those severance checks as new seed capital for startups. So we're finally seeing employees from companies like Meta, like Stripe and Twitter start companies, whether it's a Twitter employee starting a Twitter rival or someone who recently got laid off from Better.com, that home mortgage startup that became pretty viral last year for going through rounds of layoffs, starting a company that's trying to disrupt the way lawyers work. It's very interesting to see the expanse of people and how they're kind of trying to approach this problem.
And so, Natasha, when they're able to find a new position or even put some of that severance check capital to work, it comes back to what wage they're eventually going to be able to take on as well, and how that compares to what they may have previously been making. Have you heard anything on that front?
Listen, I think over 260,000 people over this year and last year have been laid off from their tech jobs. And I think it does take a very specific kind of person to be able to take the risk, as you point out, towards starting their own company. So I will say it's still a tiny percent of people that can really financially afford to bet on themselves. I wrote a story a while ago that was looking at how the risk profile has changed so much so that some people are not starting their own companies, but they're taking 2 jobs at 2 different companies without either company knowing. So I do think we're not necessarily seeing everyone be able to make that jump, but the fact that there are some new programs out there that are designed to give capital to laid off workers makes me feel more confident that that jump is going to be easier to make.
All right, Natasha Mascarenhas, TechCrunch senior editor, thanks so much for joining us. We appreciate it. And as the Fed continues its battle against inflation, there's a lot of talk these days about whether the economy will see a soft landing or a hard landing, or most recently, and yeah, explain this one, no landing at all. So where does Washington go from here? For more, we're joined by Yahoo Finance senior columnist Rick Newman, the man who's always flying high and never landing. Rick, there is talk here on the no landing scenario. What do you believe is happening this week in Bidenomics?
This is the latest buzz phrase, the no landing scenario. Yahoo Finance tweeted a real nice mashup of this earlier in the week, and I linked to this in my weekly Bidenomics update, which is on our app right now. A no landing scenario, while physically kind of impossible, would be that we do not get either a hard landing or a soft landing from the Fed trying to beat inflation. But basically, things just stay the same, which is to say we have high inflation and the job market stays strong and employment stays pretty strong. So all this talk about landing, I think we're really kind of torturing the metaphor at this place. But President Biden has his own way of talking about this. And he had remarks today when we got the numbers on wholesale inflation and also on incomes and spending. And this is what Biden's been saying. We've accomplished a lot. The job numbers look great, but we have a lot of work to do, and we need to finish the job. So basically what he's saying is we need to stick with the Biden economic plan in order to get the rest of this accomplished. And the rest of this would be getting inflation down to, let's say, under 4%. I don't know if it's going to happen. I mean, honestly, all the projections on this have been coming in wrong. Like we saw the income and spending data today much hotter than economists thought. So nobody really has a good handle on this economy. So I guess we're just throwing up our arms in the air and saying maybe it'll never land.
Yeah, Rick, he certainly is trying to spin it to his advantage. It hasn't seemed to work, though, when you take a look at the recent poll numbers, clearly not improving in terms of his approval ratings. How do you see this potentially affecting a 2024 run? And what do you think that's going to look like? Because now there's talk that maybe he won't even seek re-election.
I did actually notice one poll this week, Shauna, where Biden's approval rating ticked up. It was an NPR Marist poll, and it only went up to about 46%. That's really not that much to celebrate, but it's more movement than we've seen in Biden's approval rating in a while. So we'll have to see if there are some other polls that validate that. There has been a little bit of scuttlebutt this week that maybe Biden is not going to run for re-election after all. I think part of the reason for that is some people in the Democratic Party thought that he would have announced his plans by now. He would have said, yes, I'm running for re-election. There were some thinking that February of 2023 would be the time for him to do that, and he has not done that yet. Now, if he ends up announcing, in a few weeks, in March or even April, yes, he's running, that delay won't really mean anything. But maybe he's having second thoughts. I mean, he has signaled that he wants to run without coming right out and saying that. I think he's 80 years old right now, and he would be very old if he ran for president. And there are a lot of concerns about his age. So it would be a real shakeup if Biden decided not to run. There are a bunch of Democrats who want to run, but they don't want to challenge a sitting president. And it would also change what Biden might be able to do during his last 2 years in office. You can do things when you're not running for re-election that you cannot do so easily if you want voters to give you another chance. So it's important, this decision.
Yes, he would indeed be older than what many deemed to already be old when he ran 3 years ago. So we will see exactly where the party goes forward from here and what type of young blood gets brought in on both sides of the aisle there too. Rick Newman, thanks so much for breaking this down.
Hi, guys.
See ya. Coming up, ChatGPT may not have been around for long, but it's already proving to be disruptive. One real estate broker tells us how his firm is putting the AI tech to use. We've got that next.
It's not just agents in real estate. Everybody's using it. If you have a low IQ, suddenly you could look smart. The same kind of documents you had to review that would take an hour, you see in 2-3 minutes. People are writing emails and texts and explanatives of the market to their customers. It's like the whole world got a genius implant. This thing is such a game changer. I'm sure it's not just limited to real estate, but boy, is it helping us.
That was real estate mogul and Shark Tank star Barbara Corcoran on the impact ChatGPT is having on the real estate market. Our next guest FI Real Estate CEO and broker Filippo Incorvaya has been using the AI to streamline his business. Filippo, we got to know, how are you using ChatGPT? Is it, as Barbara says, a game changer?
Yes, 100%. Big fan of Barbara. In Miami, being a broker and representing my team, having wonderful realtors, I'm very lucky to have a wonderful team. But as many brokers or even realtors, sales associates don't have the fortune to have a great team surrounding them, we tend to do a lot of tasks all at once. ChatGPT particularly, and also many other AIs, have really been a game changer for us. I mean, to me personally and professionally, I believe is one of the most remarkable inventions in human history. Like Barbara said very well, it makes us all look like geniuses. It's a tool that makes everything much easier. It's almost like having a super assistant that is there for you 24/7 in every language possible, and that pretty much can analyze everything for you in minutes and even seconds. So for us, yes, go ahead.
Sorry, Filippo, I didn't mean to cut you off there, but how more specifically are you using it? You mentioned the fact that it's helping you analyze things. Is it helping you write listings? How are you seeing it saving you maybe some time in your day-to-day?
That's a great question. So we use it for many, many things. One of the biggest things that we use it for is basically marketing, creating a lot of cool different content in marketing. So we can shape one remark from one of our luxury residential listings in many, many different ways, depending on the platform that we're exposing this property or this listing in. So, for example, Instagram or LinkedIn or IG, or Facebook, get different sort of approaches from our marketing department, and we can use ChatGPT to create super cool different content for these different platforms.
So, Filippo, help us quantify this just a little bit further here in terms of your use of ChatGPT and the delta particularly here. You were mentioning the time, so productivity, it sounds like. But at the end of the day, doesn't it still come down to, are you getting better leads? Are you seeing a better sales price at the end of the day?
Well, that's a great question, okay? What for us as broker, and the reason why I open FI Real Estate with my team is to, number one, raise our industry standard when it comes to real estate services, okay? That's number one. So by ChatGPT making every single realtor that can utilize this technology a better realtor, it gives you more time to understand the data, gives you more time to analyze sales prices, and gives you more time to also create better ways to expose the listing and explain those buyers out there why this listing is the best property for them. So not only I'm saving time when I'm exposing my properties and my listings, I'm also helping buyers understand what's better for them at the time of buying because of the different metrics that we can analyze quickly with ChatGPT. So it's hard for me to give you a specific delta on how more efficient I am. Time-wise, I am being able to wear multiple hats at the same time in one day. So I'm very, very much more efficient than I used to be before. And given our scarcity inventory in Miami, efficiency is key, because we're competing against very, very small inventory right now for the best product out there. So it's key and essential to be very efficient.
Filippo, what about the impact on jobs? I know it's making you more efficient. Is it replacing maybe some of the tasks that some of your employees used to have?
That's a great question. It hasn't. What it's done is made everybody in my team a better professional because they are more efficient. So because we're growing. So before, my marketing person could sit down and analyze, for example, talking about marketing, and analyze one pitch and on one property in different pitches or for different platforms. Now this person can literally be much faster at that task and help me improve other tasks that I have to do from other properties. So this person becomes much more efficient for my company, and also helps me present better results, which generate more income for the company and a better more clientele. So ultimately, what ChatGPT has done for me in terms of efficiency has not really saved me money on employment, but generated more leads by creating more clientele and also selling quicker and faster.
Filippo and Corvea, thanks so much. It's always appreciated you taking your time here. Very interesting how it is disrupting or really revolutionizing, I should say, your industry. Thank you. All right, well, coming up ahead, subscriptions are popping up everywhere, even at restaurants like Panera Bread. We're going to tell you why you might be seeing so many of them coming up next. Subscriptions are certainly exploding across the U.S. economy, but that, of course, is not a new concept. Old school milkmen used to drop fresh jugs of 2% off at homes. Now, instead of that cheery man in the white, crisp, white uniform here, it's an Instacart worker. How times have certainly changed. Well, the global subscription billing services market is expected to more than double from $5 billion in 2020 to $12.5 billion in 2026. This is according to IBM. The average American had 6.7 subscriptions, so between 6 and 7 subscriptions in 2022. That's according to personal finance website Rocket Money. So here are some of the top categories for subscriptions. 90% of American consumers subscribe to streaming platforms, according to a Forbes survey. 72% to a delivery service, 60% to music, 34% has subscriptions to cloud storage, and 30% to gaming. So we asked you guys, our viewers, which of these categories would you give up first if you needed to save money? We've talked more and more about certain people cutting down on the number of subscriptions. Well, here are the results. 58% saying that they would give up food delivery. That's a bit shocking considering how popular we know that that is. About 14% will give up streaming, music, or fitness. So food delivery, the clear loser here. Let's talk a little bit more about it, more specifically what we're seeing play out in the restaurant sector. For that, we want to bring in Greg Frankfurt. He is a senior analyst for Guggenheim Securities. Greg, it's great to see you. So we're talking now about more and more restaurants adopting this subscription service. We have Panera Bread, P.F. Chang's, just two of the companies that have recently gotten into this. From an analyst perspective, how are you viewing this?
Yeah, I think it's fascinating what's going on. I mean, when you look at what restaurants are trying to do from a data perspective, from a customer, knowing the customer, and from a loyalty perspective, this fits right in the subscription piece of it. You've seen a few restaurants test out. It is definitely early days. Panera and P.F. Chang's that you've highlighted are clearly on the cutting edge of this.
Okay, and so for all of the different categories that people could choose to cut out, but they won't at the end of the day, there are some of them that are just that sticky of a customer experience. They're of the brands that are set to be the biggest net beneficiaries of that going forward and be able to then increase price later on. How do they make sure they get pricing strategy right over an extended period of time?
Yeah, pricing is the number one topic in restaurants right now. You've seen most restaurants taking their pricing up 8 to 10% year over year. But I think as you look at subscriptions, one of the things you're doing is you're basically offering your most loyal customer a discount. I was watching the episode of The Office the other day where Ryan is teaching Michael Scott about what's more costly, trying to go after an incremental customer or keep your existing customer, and that is 10 times more expensive to go after a new customer. Getting that loyalty up, getting that frequency up is a huge part of what restaurants are trying to do.
It certainly is. And Greg, two coffee companies, and I don't know if you could just say Starbucks really is a coffee company, but you cover Starbucks, you also cover Dutch Bros. And I bring these two up because they're going about this in two different ways. So Dutch Bros, you can have a reoccurring subscription there to some of their coffee beans, whereas Starbucks has that loyalty program that we were just talking about. What do you make just of the different approaches there? And I guess in terms of what makes sense for each?
Yeah, I think it's fascinating. Some of the data points that we've seen, Starbucks gives a wealth of information on their website. The average loyalty customer, which they have over 30 million US loyalty customers right now, spend about 2.5 times the amount of money at a Starbucks per month as their non-loyalty customer. So that's where you're seeing the advantages of getting people into the loyalty programs, getting them into the subscription programs and driving frequency. This is a category where if you're a full service restaurant in the US, your average customer comes 3 or 4 times a year. It is not a high frequency category in some of the spots in restaurants. And so trying to drive that up, even getting one more visit a year, can be very meaningful for these businesses.
For consumers out there that are looking to kind of cut costs and look across their own streaming or any type of, excuse me, that was a little bit of a Freudian slip of which service I probably pay the most for. At the end of the day, which is the most at risk as consumers are looking across and saying, you know what, I need to cut this one out, I need to cut that one out, and perhaps some of the trimming of their own expenses?
Well, I thought the data you were putting up there earlier about the customers potentially cutting out food delivery was interesting. We heard from CEO Russell Weiner at Domino's yesterday talking about their sales on the delivery business being down mid-single digits, the sales in their carryout business being up low double digits. And he attributed that to customers potentially balking at some of the higher prices, at the delivery fees that they're being charged. And what you've seen in that channel, you've seen a lot of these restaurants, as it's gotten tougher to hit the economics, they've priced more in that channel. So you've seen 25 to 30% price increases on what people are paying on a base menu for delivery prices versus what you're seeing for in-store menu.
Greg Frankfurt, thank you so much for joining us here today. Guggenheim Securities Senior Analyst. Appreciate the time. Have a great weekend.
Have a great weekend.
You too. All right, everyone. Well, we've been talking a lot about subscriptions here. Shauna, I have, as I count them up, five subscriptions.
5?
6 if we're counting my gym membership. No, actually, no, still 5. I got that one in there. What about you?
14, and I feel like
14.
I'm missing some.
Wow.
I need to go home and cut some of these subscriptions.
We're going to break this down actually a little bit here because I have a list of some interesting subscription boxes. We're going to play a little game here this afternoon because it's the Friday way. Pay or pass is the name of the game. Would you pay for the following subscriptions or are you going to pass? Now, first up here is the Apoca box. Oh my goodness. Okay, look at this. You can subscribe for $60.95 and get a box of survival tools every other month. Shauna, pay or pass?
Definitely a pass. $60 every other month. It's the I don't really know how much I'm going to need some of that, and I already need to declutter what I have, so I'm going to give this one a pass.
Apoca box is what that makes more sense. Apocalypse, Apoca
yeah,
box.
Apoca box. I don't know. I already have 14 subscriptions, so I need to cut somewhere. I'm going to pass on that one. All right, Brad, I've got one for you. The Cat Lady box. Ooh. If you're obsessed with cats, this might be a box for you. Do you like cats?
I do like cats.
Okay, we're starting off on the wrong
cat
foot
who lives
here.
in my home is going to force me to say that.
Well, Well, it comes with cat-themed toys for you and your cat, or if you're babysitting a cat here. You can pick between a 1, 3, and 6 month plan. The most popular is the 3-month one, $41.99 per box. Pay or pass.
Monkey, I love you, buddy, but you're not getting a $42 a month, and that's before taxes, delivery box. I'm sorry.
Yeah.
Sorry, we can do better. Target's across the street. Also, everyone, next up, letters from dead people. This is a pass. I'm sorry. We can go to the next thing. This one is a flat fee of $224.99, and you get a monthly box for a year. It's filled with clues here. I can't even stop. That can help you solve a mystery. So it's like a long-term puzzle. You solve 1 month at a time. Sean, are you paying or passing on this?
So I actually love this idea. I think it would be so fun. I like the fact it's a mystery. I like the fact that you work through it. It's a game, all about that. I would pay for it if it was a fraction of the price.
Well, what price would get you?
$224. Maybe
like $150.
Oh,
What if
a
they said
year.
$150?
Okay. Maybe if it was $50.
$50, all right.
Of what it is,
haircut.
I would be on board. What do
Okay.
you think?
Nah, it's got to be like 25.
Okay, all right. What about a slime box? I actually like this. It's a slime box club. You can subscribe and get monthly slime containers, glitter and beads, mixing tools, and candy. This is $30 a month. Pay or pass. It's a lot of fun.
You know what? Here's the thing. I'm gonna pass on this one actually, and you lost me at glitter. You know why? I'm still trying to clean up glitter from the Christmas season.
I was gonna say, why do you have glitter around your house?
So much glitter, it's everywhere.
All right, I thought it was a good. I have 2 young boys, really only one that's old enough to play with this. In theory, I think it's a great idea. It sounds very messy though, but I like it. I think they're onto something.
Yeah.
Yeah, just lose the glitter. I'll be on board.
Lose the glitter. Yeah, save that for I don't know, weekends in Bushwick. Anyway, finally we have the Crypt ID Crate. This is a monthly subscription box. This will come filled with paranormal themed items and things relating to Bigfoot, ghosts, UFOs. 6-month subscription will run you $43 a month per box. Pay or pass, Shauna?
Hard pass.
Hard pass?
Hard pass.
The Sasquatch Field Guide looks mighty appealing, though. I don't know.
$43 a month?
That's not terrible. I can cancel it after a month. I just need the field guide.
Okay, all right. So this is a one month
Just in
and
case
done.
you come across Sasquatch out there.
All right.
All right.
Well,
And you
yeah.
got
My
a big
takeaway
turkey.
from this is that I have way too many subscriptions.
We can trim that down.
Yeah, we got
We'll work
it.
on that.
We're going
Everyone, coming up, we're going to set the scene for some of the biggest stories investors are going to be following next week. Stay with us. It is closing time at Yahoo Finance, and here is a look at 3 things that we're watching next week. First up, Wednesday, we have Tesla's Investor Day. CEO Elon Musk giving a small preview, tweeting that he'll be unveiling Master Plan 3, the path to a fully sustainable energy future for Earth. Among the issues Musk is expected to address, updates to Tesla's self-driving system and the Cybertruck. As far as the stock goes, Deutsche Bank's analysts believe that the Investor Day has the potential to help the stock keep re-rating higher.
Also on Wednesday, after the bell, we will have Salesforce's fourth quarter earnings. The company has become the target of 5 different activist investors, including Third Point, Elliott Management, and also Starboard Value. Now, investors will be looking to see if CEO Mark Benioff addresses those activist concerns. We will also be watching for any updates to the company's 2023 outlook and for insight into how the broader pullback that we are seeing in tech spending is impacting Salesforce's business.
And on Thursday, we have a big day of retail earnings, among them Macy's and Best Buy, which report before the market open. After the bell, we'll get results from Nordstrom and Costco, Yahoo Finance's 2022 Company of the Year. This week, we got signs from Walmart and Home Depot that the consumer is starting to pull back on spending. We'll be watching these retailers to find out if they are seeing and starting to see the same thing. We'll also be looking to see what these retailers say about buying trends during this period of high inflation.
Certainly a lot to look forward to next week. Well, that does it for us for this week on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here on Monday, 3 p.m. Eastern Time. Have a great weekend.